Happy New Year, everyone, and welcome back to Modern Finance. My name is Rosario, and I'm joining you on a snowy evening here in Vancouver, BC, Canada. What an insane year we had in 2021. Despite the media panic and widespread fear, uncertainty, and doubt about the Rona, I'm actually cautiously optimistic about our prospects for 2022. I believe that there will be several opportunities to grow our wealth, and if we take advantage of them, you and I can both prosper in the year ahead. In this video, I'm going to cover an investment strategy I'm using to grow my wealth in 2022 at a faster rate than the market, and I'll show you exactly how you can implement this strategy in your own portfolio. Let's begin. I'd like to start with three major areas that we often talk about on this channel: stocks, crypto, and real estate. I've made almost all of my money investing in these three asset classes. I know that there are more out there: high gold, and of course bonds, treasury bonds. But these three asset classes are the things most likely to get you a return in 2022, in my opinion. Another investment that I mention less frequently is really just an extension of the first asset class, and that's investing in private businesses or starting your own business. Of course, there's many ways to decide which investments that you want to take part in, but there are two key factors that you can use for every single investment that you make from now forward. The first is expected return, or the expected growth in a stock or other asset's price. There are many ways to figure out what an asset's price could be worth. For stocks, you can use a DCF or discounted cash flow statement. You can also do a comparables analysis, or you could throw darts at a wall, or you could use a Ouija board. I'm not going to go into details on how to value a company because I've done that in other videos, and to be honest, it's hard to value companies and real estate, and it's even harder to value cryptocurrencies in 2022, so I'm not even going to try. The second way to generate higher returns on your portfolio compared to your peers is by understanding and exploiting risk. That's what we're going to talk about in this video. And it also has an important bearing on your investments in 2022 in particular, so pay attention. In general, the higher the potential return of an investment, the greater the risk of that investment. For example, you could have invested in Squid Coin and made 10,000% on your investment in a matter of hours. But the downside is that you could easily have lost everything if you held onto your investment for a few more hours. The thing that not a lot of people talk about these days is that there are actually two components to risk, and you can invest in assets that have a better trade-off between risk and reward. The reason for this is that some risks are priced in when you buy an asset and some aren't. In general, if a negative risk isn't priced in, you're paying more for that asset than you should. For example, you could have a portfolio that consists entirely of Pokemon NFTs that has returned 120% over the last year. You could also have a portfolio consisting of multiple asset classes like Bitcoin, Tesla, stocks, and real estate that also had a return of 120% in the last year. Based on the return rates, these are equivalent investments, right? Well, not exactly. Remember how I mentioned that there are two types of risk? The first type of risk is called idiosyncratic risk. That's just a fancy way of saying that it is the risk that affects only one particular asset or group of assets. It's like if I buy a bunch of Tesla stock and then the next day Elon says he's going to sell 10% of his Tesla shares, crashing the stock price. That risk is probably only going to affect Tesla and not other auto manufacturers or the entire US stock market. Every individual stock and asset has idiosyncratic risk, but that risk isn't necessarily factored into the stock price. The same can be said for individual pieces of real estate or individual cryptocurrencies. Each home has risks of owning it that can affect its value, like an improperly sealed drain that leads to the house flooding. An example for cryptocurrency could be that Cardano, ADA for example, is found out to have some fatal security flaw that requires a redesign or hard fork. It doesn't necessarily affect the price of Bitcoin or Ethereum, but it would definitely tank the price of Cardano. That's the idiosyncratic risk. Because idiosyncratic risks are by definition irregular and unpredictable, these risks are usually left out of valuations for individual stocks. Unless you're an insider or have very detailed knowledge of a company, it's really hard to predict exactly what the CEO might do, or if the company will release a new product that changes the industry in the next quarter. So what does this mean for your portfolio and for investing in 2022? Well, remember how I said there were two types of risks? The other type of risk provides the key to show how money is made and how to maximize returns. The second type of risk is called systematic risk. That's a fancy way of saying that it is risk that is inherent to an entire sector, asset class, or economy. Think of the Rona and specifically Omicron as a huge systematic risk that threw a wrench in the markets and is currently confusing millions of investors worldwide about the prospects for growth and inflation in 2022. The key thing to understand is that systematic risks and their consequences decide the overall direction of the market and chart the ups and downs of entire countries, industries, and asset classes, while idiosyncratic risks reflect the dangers inherent in owning shares in a single company, in a single cryptocurrency, or in a small group of assets. Sure, this all sounds great in theory, but how can we take advantage of this knowledge to grow our wealth? One word: diversification. Okay, I'm sure 80% of you either just sighed or reached for the thumbs down button. Please don't smash that dislike button and rage quit just because I use the D word. Just give me a minute to explain, and you'll see why a well-diversified portfolio could help you grow and preserve your wealth in 2022 and beyond. Okay, you're still here. Great. I'm guessing that because you're watching this video, you probably aren't a billionaire already. Rich people diversify their assets to preserve wealth. They throw money in multiple asset classes to protect their generational fortunes from dissolving away during boom and bust cycles of the market and through inflation. Ever heard of the 60-40 rule? That's 60% stocks and 40% bonds. The reason for that rule was to provide diversity in your assets. Bonds typically provide a more stable return than stocks, but stocks can provide a greater return. The reason that portfolio split doesn't really work anymore is because bonds now provide a consistent negative real rate of return, so you're guaranteed to lose money. With US Treasuries, you're losing 5 or more % per year to inflation for the privilege of buying and holding government debt. The only reason companies and individuals still hold bonds is because having their money in cash provides an even lower rate of return. So that's great, right? I can diversify my portfolio and lose 5% per year. How does this help? Well, it's also possible to diversify with riskier, think higher reward, asset classes to achieve a greater long-term reward than if you just invest in one of those assets over the long term. Remember how I said that idiosyncratic risk of a security isn't taken into account in its share price? Well, that's true. But what it means is that, by definition, a group of relatively uncorrelated securities with a similar expected return will outperform a single security in the long run. If this kind of sounds like a really long-winded pitch for index funds like VOO and VTI, it is. But it's also a technique that you can use to construct your own portfolio of riskier, high-return assets so that they will outperform other portfolios with more idiosyncratic risk over a long period. Just remember, what we're trying to do here is build wealth over time. We're not YOLOing in on the latest shitcoin. Obviously, day-to-day and month-to-month fluctuations will vary portfolio performance, but over time, this strategy will always win mathematically. Of course, all you crypto millionaires watching this, living on your yachts near Puerto Rico, are laughing right now, but hear me out. I'm going to summarize the strategy in one sentence. Build your portfolio from a few risky, high-reward, highly uncorrelated assets and only make changes to your portfolio when you get new information about the systematic risks that could affect all of your assets or the idiosyncratic risks that could affect one or more of your assets. Simple, right? Good luck. Well, at least I can help you get started. By using a tool like the one on portfoliovisualizer.com, you can see how correlated your stock portfolio is. You can also use other tools to see how correlated real estate, cryptocurrencies, and stocks are with each other. Your goal is to get the correlation of the assets in your portfolio as low as possible while keeping the potential return or risk high. By lowering the correlation of your assets, you're also lowering the unpriced idiosyncratic risk in your portfolio. For example, I might think that Bitcoin and Tesla are going to do really well in 2022. I do. That's great. But the problem is that Bitcoin and Tesla prices are fairly highly correlated. That means if Bitcoin does bad, so does Tesla, and vice versa. Of course, the old Latin adage, post hoc ergo propter hoc, comes to mind. Correlation doesn't mean causation. But who really cares what the cause of your portfolio falling by 50% is? The fact that you lost half your money because your assets were too well correlated and both fell at the same time is more important to be concerned with at that point. So, what are some uncorrelated asset classes that might do well in 2022? As it turns out, it's hard to find individual assets that are completely uncorrelated, but you can pick better and worse options. For example, it's often said that you should diversify internationally, and that investing in only the S&P 500 will not diversify your portfolio well enough. That may be true. However, historically, global markets are 97% correlated with the S&P, so you're not getting a lot of bang for your diversification buck by investing in the S&P as well as other global index funds. Cryptocurrencies were relatively uncorrelated with the S&P 500, but recently that correlation has been growing. It's still better than a perfect 1.0 correlation, but it's only about 0.6. So including some cryptos in your portfolio is probably a good idea for reducing idiosyncratic risk. Commodities like gold, oil, and holiday fruitcakes are less correlated to the S&P at about 0.55, so that's a start. Cash is really uncorrelated at 0.06, but cash is trash, and the return potential is very limited and pretty much exclusively in the negative direction. So I'd stay away from that. Look, the S&P 500 will do a pretty good job of diversifying and will give you decent returns in the long run. But if you're really looking to grow your wealth, maybe look for 4 to 6 individual stocks or assets that you can hold that are not super related to each other and will provide large returns. For example, Pfizer will probably continue selling medicine if Tesla goes bankrupt, and Tesla will continue to sell EVs if the Rona suddenly goes away and Pfizer goes bankrupt. It's not perfect diversification because they're both headquartered in the US and they both rely on money from US consumers. So they're both affected by some of the same systematic risks, but their idiosyncratic risks are fairly different. So what am I doing in 2022? Well, I'm picking a few different assets and splitting my money between them. These are assets that I know really well and that I believe have strong return potential. I also think that in the long run, the performance of these assets will not be heavily correlated, besides a general upward direction over the next 5 to 10 years, hopefully. I'm not going to do a reveal right now, but I can let you know that I'm excited about every one of my investments. I don't invest in anything that I'm not excited about. I hope this video was helpful and will get you thinking about how to maximize the return on your portfolio and minimize unprofitable risk. Let me know what you're doing in your portfolio in 2022 and what you think down in the comments below, and we'll talk to you all in the next one. Peace.